All right, let's bring in Michael Zarembski, Director of Futures and Forex at Charles Schwab, here to help us take a look at the fundamentals behind the technicals. Michael, let's just begin with, well, first of all, thank you for sharing your Tuesday with us. Talk to us a little bit about what's gold telling us at these levels, breaking out with the conviction we're seeing, the energy, the follow-through, and the commitment, rewarding the longer-term bulls in a big way.
Good morning, Ben. Absolutely right there. Gold's move has actually been quite impressive there, especially given, like I said, those headwinds of higher interest rates overall as well, too. And if you actually look at gold's performance this year to date, it's up 15%. That's actually outpacing what we're seeing in both the NASDAQ 100 and the S&P 500 as well, too. So, yeah, it's definitely gold bulls' time to finally shine here. And I think one of the reasons why, I think you got to look at who is really behind this buying here in the gold, especially, and maybe silver there to a little similar extent there. One of them, it's central bank buying. Central banks have been large buyers, especially over the past couple of years. In fact, the largest purchases by central banks on record there occurred in both 2022 and 2023. So right there, you're seeing these large, aggressive, long-term holders of gold buying the physical metal. In fact, this has been a trend overall of net buying by central banks since 2010. And what also happened since about that time, Ben, we've seen those central banks there actually reduce their overall holdings of U.S. Treasuries. It peaked at about 40% of the available supply back in 2008. It's currently about 14% today. So you can almost say here that we're seeing a longer-term trend here of large buyers there buying physical gold there and actually reducing treasuries there. I think this whole thing about rising rates there being a headwind there may not be a factor there when you have a buyer like central banks here who I don't think are really interested in what's going on in U.S. rates here as well, too, when they're trying to really diversify their holdings from U.S. dollars and U.S. debt there into something like precious metals.
You know, that's what I've been arguing for a while here, because we have seen rates on the rise, yet gold continues to just charge and push further north. So maybe, again, investors are just content with the idea that October of last year was peak, right? Until we start hearing talk of or whispers of a shift on the Fed side of things, that they're pretty happy with Powell and the stance that they're taking right now. I like your point here, Michael. For one, I kind of feel like rising tide lifts all boats in some ways. We're going to, pull up this chart because I think this is important. We also have silver, which is on the move higher as well, right? And here you can see it's getting a lift recently back above 28. As I take a look, also copper, another product recently back above 430. But, if they're not buying treasuries, if they're buying gold instead, maybe it's just kind of safe haven type buying, some insurance type buying, as we're at all-time highs in stocks, right? Investors look for some other avenues, some other areas to diversify their portfolio.
Absolutely right there as well, too. And I think it's really interesting also there that a lot of the buying is actually more in the physical market, but not actually in the gold ETFs. In fact, we've seen net outflows of gold ETFs so far this year. And I think what that is that some of those holders of gold ETFs might be more like your equity investors there as well, too. They probably held these positions for years and finally are seeing this rise to all-time highs there and actually taking some profits there on that as well, too. Whereas the physical buyers, especially overseas, if you look at Chinese buyers, Indian buyers as well, too, they're a little bit more inelastic there as well, too. They're not kind of trading their position. They're really looking for that store of value there, especially in China there. Let's face it, we've had horrible returns there in real estate. Their equity markets have been doing nothing as well the last several years as they've been in a deflationary environment there. So for those buyers there, having gold, that store of value that I think is actually more important there. So I think it's really depending on who is actually buying there. And like I said, U.S. investors there and ETFs here taking advantage of this rally here to kind of lighten up the load. And I think also that's why we're seeing silver now actually starting to play a little bit of catch up to gold as well. It's up 17% year to date as well. But if you look at the gold silver ratio, Ben, we're about 84-1 there as well, too. And that's actually at the higher end of the last 10 years as well, too. So I think that silver market there is really just more of a catch-up trade because we're still well below the all-time highs around $50 an ounce there in silver. So it's not necessarily that they're just looking at precious metals in general. It's really more of a gold story here. And I think silver is just kind of going along for the ride. But if you look at markets like, let's say, platinum and palladium, which are a little bit more on the industrial side, though, but still considered precious metals. They're actually down year to date as well, too. So really, I think this is truly a gold-specific story here as well, too. And I think some of the other metals there are just going along for the ride.
As I look at the board here right now, I've got platinum up almost 2% here. Silver is gaining by 1%. Gold up 0.75%. As we watch metals on the rise here, it feeds into that inflationary pressure discussion, what the Fed doesn't necessarily want to see in terms of reversal of some of the progress they've made on driving inflation back down to their targeted levels. Talk to us, because crude kind of feeds into that narrative as well, right? Recently and currently stubbornly at these 86, 87, 88 levels. You've got Brent, which has been holding above 90 for some time now.
Right, but that I think is more of an actual supply and demand situation here as well. You know, the OPEC cutbacks here as well is definitely tight demand, and we're still seeing overall global growth here actually being steady there, especially here in the U.S. as well too. And then if China starts to pick up as well too, that's going to add another catalyst as well too. So I think actually the oil market is actually more of that kind of fundamental state as well too. But you're right, it overall kind of fans the fears of rising inflation, especially energy prices, and how important it is to the global economy as well too. So yeah, we're starting to see that in some other commodity markets as well too. We've seen that in the softs with cocoa and orange juice making historic highs. Coffee starting to perk up as well too. So I think it's really just some of the food prices there, like for instance, the grain markets there still haven't caught any kind of bid as well too. If that starts to feel the fan of it well too, adds more to food inflation as well too, and that's definitely not what the Fed or any central banks wants to see.
No, definitely losing progress on some of the headway they've made on inflation is not what they want to see. And I would argue, getting back to earlier, that number we mentioned, the NFIB, I mean, not what small businesses want to see either, right? Energy prices on the rise ultimately, or us as consumers for that matter. So it kind of has widespread tentacles here, wide-reaching, I guess. Michael, appreciate you joining us here. Look at commodities on the move higher and, well, ultimately the impact this could have on the Fed and us, for that matter, again, as consumers. Michael Zarembski, Director of Futures at Charles Schwab.